All right, guys, let's get into this. I've done over 4,000 real estate deals with an eighth grade understanding of math. And today, I'll show you why that's an advantage, not a liability, because I get asked all the time how I analyze properties. People think I'm a numbers guy, a data driven, analytical. Nah, the truth is, numbers confound me. And I'm terrible at calculations. But what is my Achilles heel turned out to be one of my investing strengths because I'm forced to keep things simple. And it's that simplicity that allowed me to do all these deals. And the other thing, you just can't do the same thing others are doing and expect to outperform. So in this video, you'll get the techniques that I use that very few investors have even heard about. So see what I do. Copy me, bank it, repeat it. If you need my guidance along the way, book a call. So here's what we're going to learn. Second level investors will always dominate their market, and how to avoid analysis paralysis using the SNAP method, and how to be bad at math and still make millions. Why retail investors always get it wrong and go broke doing it. And how simple napkin math can help you analyze deals quicker and do more of them. So if you haven't heard of me yet, I'm not a YouTuber. I'm strictly an investor. So this is a one take, no edits, no fancy graphics or balloons, just real strategies, proven systems, all my best stuff. I founded House Buyer, the pioneer we buy houses investing model, and I did 4,000 deals, kept the best, flipped the rest, built a $12 million portfolio, founded RIA, one of the top RIAs along the way, helped hundreds of other investors get better. So real estate is simple, guys. So many people overcomplicate it. Over the years, I've used and improved a simple method to get great deals done fast. It's called my SNAP method, simple napkin analysis process. And 3 decades later, it's now battle proven and repeatable to help me and my clients filter prospects from suspects and then determine if and how a deal can be done. So keeping this method simple is actually what allowed me to do all those transactions. And it allows you to go through high volume of leads quickly while allowing the cream of the crop to rise to the top almost automatically. So 3 keys to the SNAP method. First, it's anti-fragile. This built on a system that doesn't just survive market shocks and up and downs and deals gone wrong, but get stronger from them because you've got a track record, a checklist, a track to run on. So you plug in those problems so they don't repeat, and it lowers the risk. So there's less moving parts, meaning less to go wrong, less things to break. And probably my favorite, it's easily repeatable. Don't have to think up new stuff every time. And it's offloadable. So I'm able to put this method into my system with a checklist that's easy to do, easy to follow, and then I can easily hand a lot of it off to my assistant, which frees me up to do more higher level investing. So every investor in your market is looking at the same houses on Zillow and the MLS, and you know it. I stopped looking at houses years ago. Here's what I look for instead. Simple napkin math for 2-3 factor setups. Second level investing to find those hidden, overlooked opportunities, those benefits or property assets. And then ways to create good deals, great deals, more than finding great deals, right? So all those investors on Zillow trying to find a deal while I'm creating deals. Do you see the difference? And we're going to talk about that because it's not just wordplay. So by using those 3 methods, I'm able to avoid the things that prevent other investors from taking action, like the people who are hyper-focused on the numbers, often numbers guys, but they struggle with actually pulling the trigger on deals, or they're too late once they get around to it after beating the thing to death, and information overload stalls or stops their progress. And the other guys are just too afraid, and they mask that fear by overanalyzing every possible outcome and metric. What if that, what if this? And by the time they get around to it again, the deal is gone. So they say a great business plan can be written on a napkin and explained in 2 minutes. The same principle applies to a great property deal. This doesn't have to be complicated. I've done enough deals to say real estate is simple. So using the SNAP method, I'm able to determine quickly the reasons the property is a good deal, and without spreadsheets or getting slowed down and bogged down in the minutia. Great deals are created, rarely found. I should change that because good deals are created, rarely found. But I'll give you the factors in a second. But first, I want to explain what second level investing is and how it's different from 99% of the other investors out there that I call retail investors. So, as president of RIA and coaching investors for a long time, I got to know some of the best investors in the country. One thing that they rarely say is, I found a great real estate deal. Now, that's a common phrase bantied around by a lot of investors. I found a great deal. I know what you mean. The best investors actually say, I created a great real estate deal, or something to that effect in terms of creating, not finding. Big difference, guys. This isn't semantics. Second level investors don't find the deal, they find the opportunity, yes. Then they create the deal. Contrast that to the retail investor. So the one who's always looking in the same places that hundreds of other investors are looking, the Zillow, the MLS, maybe calling some signs on the yards. They assume the numbers on the property are the only way of determining if the property can be a deal. The numbers. That's it. And then the retail investor just doesn't know the concept of your price, my terms, or your terms, my price. I'm going to do a whole video on that because that is such a great way of getting deals for your alternative acquisition plays. So no money down, no banks, seller financing, 100%, and getting great deals on properties. Retail investors have no idea that concept. And here's a comparison. I'll just fly by this quick. You can screenshot it. But the retail investor is just simplistic. Like I said, the numbers. What's the story behind the numbers? And so they're very superficial. Second level investors go deep. Of course, they're going to follow the crowds and conventional wisdom. Second level investors, almost always, they're contrarians. They're skeptics. They're independent thinkers. Retail investor is going to accept surface level conclusions, like, well, looks ugly. Avoid it. Whereas second level investors, they're going to question assumptions and dig deeper. The outlook is good, so buy. The market is up. Let's buy while it's up. And it keeps going up, so let's keep buying more. So no, the second level investor is going to say, look, the outlook's good, but everybody knows it. So the price is inflated. So we should probably wait until the market corrects. And of course, retail investors are going to be reactive to obvious information versus anticipate what others are missing. So to create great real estate deals, you must think differently from the other investors, which by definition means your thinking has to be different, right? If you're a retail investor, don't worry, I was there. Most of us start there. But staying there is a sure path to burnout and limited opportunities and disappointment. So here's some practical applications on graduating from retail investor to a second level investor. And the napkin math that I look for, the behavioral edge. So a retail investor says, everyone thinks this property's falling apart, so do I. My agent said it's a dump, this, that, and the other. I ask, is the panic overdone? Can I buy at 40, 50% discounts? Because everybody's running for the exits, right? The opportunity is to exploit that gap between the perception and the reality. The best deals often do feel uncomfortable, but understanding psychology and behavior gives second level investors a huge edge. Contrarian opportunities. Be a contrarian. The market's hot. Everyone's buying. I should too. The market is hot and priced to perfection, just like the stock market. One wrong missed earnings, one CEO who flubs something or loses something in a keynote, and the stock tanks, right? So where's the fear? And what happens when sentiment shifts? The opportunities: buy when others are fearful. Recessions, wars, which seems to be never ending, rate spikes, distress situations, and then sell when cap rates compress to historic lows and euphoria dominates. There's a key line. I learned this 30 years ago from Jim Rohn. Be a straw hat buyer in the winter. Right there. Screenshot it. Be a straw hat buyer in the winter. So market cycles is the other one. Rents are rising. This could be prices as well, but rents are rising 8% annually. They'll keep rising. Property values keep going up. They'll keep going up. No, rent growth is above the long-term trend. So ask what supply is coming online. What's the employment outlook? How will new construction affect vacancies and property values? And the opportunity here is to take the market temperature. Real estate markets swing like a pendulum back and forth between euphoria and depression, fear and greed. Buy near depression points, fear, when everybody's fearful. And Warren Buffett says this. He's been doing this for 30 years. And then sell near euphoria. Real estate is the same. So rarely do prices and rents run too far from their normal trends without snapping back. So when property corrects, either from you improving it, rehabbing it, or the market sentiment, it's like a pendulum swinging, and the prices and rent come back in after they're overextended, like a rubber band. When you pull it tightly and it snaps back, it doesn't just stop right where it was. It actually goes further if you were to see it in slow motion. It's just like the real estate market. And by the way, great stock traders do use these same principles. One of them is VWAP. And I've done VWAP in real estate, and it is remarkable how accurate this thing is in gauging fear and greed, and how standard deviation always kind of goes back in, just like that rubber band, snaps up, or dropping a ball. You drop it higher, boom, it comes back up higher. So this helps investors identify overbought and oversold conditions. That's for another video. And then, so by analyzing the value gap, the returns come from paying less than what an asset's worth, obviously, but not from guessing short-term market moves or speculation. If you want to gamble, go to Las Vegas. They'll give you free drinks while you're there. In real estate, you want to speculate, you're just going to lose your butt. So the retail investor says, this property generates $20,000 a month. Seems fair. Or a year, Second level investor, what is the intrinsic value based on the alternative uses of the property? Overlooked, hidden features, a zoning, assets, a path of progress play for future appreciation. And then the opportunity there is just to focus on the intrinsic value analysis. If the replacement cost is $100,000, but the property is selling for $75,000 due to a temporary distress, something you can easily fix, something cosmetic, that's your edge. So by now, you maybe have some questions about what we covered. Here's a few that I get that I'll just answer that. What are the actual 2 or 3 factor setups of your napkin math? Well, rough purchase price against comps, a ballpark repair number, and whether the numbers cash flow at a conservative rent. If 2 or 3 look good, it's worth a closer look. And are you telling me to ignore the data and spreadsheets entirely? No. I'm telling you not to let a spreadsheet be the reason you never make an offer, either because you're too slow and miss the deal, or the numbers analyzed in such a way that you're just not quite sure because one says this and use quick math to filter, then go deep only on the ones that survive that filter. So what does a created deal actually look like? Well, first, it's helpful to look at the alternative. Like I said, you either create a deal or retail investors find deals. So here's what finding a deal looks like, and then I'll get to created deals. When you find a deal on the MLS or Zillow, you've got hundreds of other investors finding that same deal. Therefore, you got a ton of competition. And at that point, you really got no advantage. You got no advantage over your competition because nothing sets you apart. Contrast that to creating a deal. You contact a distress motivated seller. You find out if they really need the money all cash in a week, or do they want to save their credit and avoid foreclosure and just be done with it, set it all aside? So you use alternative acquisition options to creatively structure that deal using no money out of your pocket and no banks. Banks bad. No credit, no banks. We don't need that. And the other one is, can a small scale investor like us compete with the big guys who have the real data teams? Absolutely. In the single family and small multi level or small multi-family level, speed and relationships beat sophistication every time. These big funds, they're too slow. They're like big ocean liners or cruise ships. You ever seen one turn? It takes forever. We're these little speedboats. We can be in and out lickety split. So here's the key takeaway: you can't do the same thing others are doing and expect to outperform, right? So what you're seeing a lot out there um, on the interwebs, everybody kind of doing the same thing, jumping on the same bandwagon. Maybe that lasts for a little while, if it does even work. But you can't expect that to be any type of business strategy. So, second level investors buy what others won't, from complexity that they can understand, wrap their mind around, like some of the things the retail investors can't that I described. The property's distressed, and you can easily fix that, or it's mismanaged. And then sell what others love when it's priced to perfection, when that market is screaming for you to sell. I know some of you landlords, you buy and hold guys, you don't want to sell your properties at these inflated real estate prices, which they're currently at, because maybe you're afraid to get the other deals. You're afraid you won't find the deals to replace them down the road, or maybe you just can't even go 6 months for them to find a great deal because you need that cash flow. I was there. I've exited 3 times, almost my entire portfolio 3 times, and bought when the market went down to replace those. So it can work. It can definitely work. And then think in probabilities, not certainties. And second level investors are intellectually independent. When the crowd moves one way, we don't. Real estate investor who can consistently outperform is willing to do the hard work of analyzing the market and what it's missing, not just confirming what the market already believes. So I hope I wrote that so that makes sense. You want to be skeptical of what the market is believing, what the deal is believing, what your agent is telling you about this property. All those, be skeptical. So here's what a lot of people miss, that you just can't manipulate numbers. And I actually do love this about numbers. 2 plus 2 is 4. There's just no opinion about it. You can't have your opinion about numbers. Rent is rent. The price is the price. Cap rate is cap rate. Everyone's looking at the same facts. But while your competition is building that 40-tab spreadsheet, trying to what if it to death, you can already have an offer accepted. I do this all the time. I'll beat investors to the punch. They're still opening up their Word doc or whatever, and sorry, we've scheduled the closing. So that's the edge. Not better numbers. You can't really fudge the numbers or make up new numbers, but faster judgment on the numbers that exist. And that's where being a second level investor really changes the game. You're not just reading the numbers, you're reading behind them, and also looking further into the property, into the seller's situation, what's all involved in that property, talking to the neighbors around it, calling downtown, finding out what the zoning is and things like that, what code is up to. So I call it being a real estate detective. And it's where second level investors kind of have an edge. You're not just reading the numbers, you're reading behind them, but you're building a case out of the small clues that most people drive by every day. Can the zoning be changed to add value? Does the seller need the money or just debt relief? And what's the tax base, or why is the tax basis lower than every other comp in the block? And then what permits were just pulled 2 doors down, or who's filing a petition for a new construction building a hospital at the corner lot or across the street. Just had that happen. One of those strip malls or a gas station with attached beauty salon and Pizza Hut. Quick thing, drive just went in right across the street. And then, is that deferred maintenance cosmetic or structural? I love those type of deals when it really looks ugly. Oh my gosh, that thing's don't even lean on the door because it's going to fall over. So none of those show up in a spreadsheet, guys. They just show up when you actually look at the property, talk with the seller, and that's what opens up these opportunities that others just drive by without even noticing. So that's my second grade advantage, second grade math advantage, and second level investing. So I love teaching case studies because it's such a great way to show you real world deals. And in the next video, I'll have a case study where it's highlighting all these items we just went over, these key takeaways. And in it, you can see in practical terms, real life scenario, how you can use second level investing to create better deals more often for bigger profits, all while the competition is still doom scrolling Zillow. But until then, I have an off market opportunity guide I made, and it's for deals just like the case study I'm going to show you in the next video. So it's 18 overlooked property types that most investors never think of even doing or look for, and they drive by every day. So you can download that with a link in the description. And if you want a consistent semi-automatic stream of leads without breaking the bank or spending hours online sifting through non-deals, my lead generation engine and the two rails it runs on, my buyer builder and seller attraction system, is available for you. You can get those systems up and running in your business as a client. So you also get my eyes and mind on your specific business and deals. So click the Work With Me link to book a free call to see if and how you might be a fit. Until then, guys, stop looking for deals. Start creating them. Have a great one.